It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, welcome back. Another episode, Managing Your Financial Future. So happy to be here. I'm Johnny Dean. I really enjoy this part of the job. I really do. There's a lot going on behind the scenes, where I do a lot of writing and I do a lot of preparing and things like that. But when you actually
get research,
yes, exactly. And when you finally get right behind the mic or you get in front of the camera to do the webinar, whatever it is, that makes the job.
It's like, well, on my side of the job, my name's Rick Plum,
Professor Rick Plum, certified financial planner, CFP professional.
I do a lot of the planning,
yes.
and so a lot of the planning happens behind the scenes. And while I do enjoy creating the plans and working the puzzles, as I call them, behind the scenes, the best part of it is talking with people, being with the clients, being with the people that are asking questions and helping them out face to face. The behind the scenes is fun, but the best part is being with the people, and being on the air like right now is kind of like being with,
it is.
With the people.
It is in many ways, and every advisor I've talked to, we've had Jonathan Savona on. He's said the same thing. Where it's okay. It's good to put all the stuff together. But when it comes together, and he said it or somebody said it, they said, when you get this strategy and this plan together, and you get in front of the person and you're actually talking to them and showing them how it works, he says it's just awesome.
Well, just the interaction, just talking to people and seeing them, maybe the anxiety level dissipate from them when they realize they can do what they want to do, or that this current market is not devastating their life.
That's just it. So you get this strategy, you say, I can't wait to show them this. That's just part of the fun part of this job. And for me, that's always been it's worth all the work behind the scenes once you finally get on and do it.
It's wonderful.
Yeah, it is. So I am Johnny Dean. I'm your podcast host, and welcome back to the program. We are going to be talking. Today's topic has been on a lot of people's minds, and it has to do with interest rates. So we sort of glanced over the subject a little bit last week when we wound up talking about stocks and diversification and all this. But as the stock market, as the specter, as they say, of higher interest rates started to loom, stocks started to sell off, and then interest rates came up and stocks started to sell off again. And it kind of, what do they call it? They call it a flight to safety or flight to quality.
They call it, I don't know what's going on, so I'm going to get the heck out of anything risky.
Does it seem like this is people? I mean, what this is? Is people using stocks as a short term, very short term.
Well, for years we've been using, people have been using stocks for income generators because there were no interest rates.
Yeah.
I mean, you could put your money in a CD and get, a
Nothing.
0.25%,
Yeah.
or you could put your money in a stock and get a 1 or 2% distribution on a dividend.
Right.
And so a lot of people have looked at, where am I going to get cash flow from? Where am I going to get income from? And unfortunately, and this may have been one of the reasons the stock market did fairly well over the years, when interest rates were in the tank,
yes,
they didn't have many options. And so they were using stocks, but it was a more normalized interest rate environment. Even though it was very low, it was more of a traditional interest rate environment in that super short-term rates were super low and midterm rates were only low, and longer term rates weren't quite as low. So the longer the maturity was, the higher the rate of return, the higher interest rate that you were receiving. Mm-hmm. And so it was a more traditional style that short-term rates were lower than longer-term rates.
That's the way it normally
is. Typical.
Yeah.
In fact, when it goes the other way around, like we've seen recently, where the shorter-term rates are higher than the longer-term rates, it's called an inverted yield curve because it's backwards in some respects. It's not supposed to be that way in general economic terms. Where 1 year and 2 year rates are higher than 10-year and 30-year rates.
Yeah, you're supposed to be rewarded for leaving your money
tying up your money
for a longer period of time. The reward is supposed to be greater. Now, as we sit, where we're talking here in the middle of October here. I don't know when people are listening to this, but from where we sit right now, The I think it's the 2-year was right around 4.4%?
Right there, yeah.
And the 10-year was
just
around
under 4.
3.9 something.
Right, it was just under 4.
So you are not rewarded for waiting 10 years. Now, what is the effect of that, first of all?
Well, the whole idea is, why are people jumping on the 2-year and making the rate where it is? Why versus the long year? Because they don't expect the rate to last that long. They don't expect, the other side of it is they don't. I think it's weird because it's like, well, if the 10-year is only paying, if the 10-year was paying 4.5, do I want to tie my money up for 10 years for 0.1% better? So generally, you want to have a little bit higher rate of return. So people, now that the economy is showing that the shorter term rates for whatever reason are higher, with the Fed raising the short rate and moving up, but people not believing that the long term is going to be as efficient. The 2-year rate's not a bad rate, and so people are starting to deal with that.
Well, especially given what we've seen for the last 10
what
years.
What we've gotten used to.
We have. I mean, my gosh! Remember when the 10-year was 5%? People didn't really care that much for it. That was back in around 2007 or 2008.
Well, we've gotten used to things on both sides of the equation. We got used to mortgages being 4% or less. And now we're all appalled that mortgages are 5, 6, 7%.
When back, 20 years ago, they were 9%.
Yeah. Well, I remember I bought a house in 96 and I got a 7% fixed rate. And I thought, man, I'll never refinance this.
Oh, man.
And yes, I did.
So why, first of all, why is the 2-year rate higher than the 10-year rate? Who set that?
Well, nobody. The market sets the 2-year.
Exactly.
The market sets 2-year. The Fed only changes very short-term money. The only rates they control are the overnight
rate, yes.
And so and everything else runs off that. And the investors, the markets, set the rates for everything else. What am I willing to pay for, and what am I requiring as a return on what I'm buying?
So I got to ask you this: if a bunch of people are jumping into the 2-year because they don't, they're doing this flight to quality that we talked about, why would the interest rate be higher? Like it would seem to me that the interest rate, as more people jump in, the interest rate would go down.
They're not indiscriminately buying in and just saying buy it at whatever cost. They're saying I will buy it at this cost, and so they're buying all the secondary market at discounts to be able to run their rate up higher, their yield up higher, which means that people that are buying bonds from the Treasury at IPO and things of that nature are only paying X for. So it's not like
it's the secondary market, you're saying?
The secondary market setting the price, and then the IPO and the initial offering of bonds are following that. And so, because they're going off at auction and the auctions are coming in, I'm not willing to pay X for a bond, a Treasury that comes off that's only going to yield me, 0.5% over the next 2 years. Why would I do that? My bid is going to be such that it'll give me 4%, and the government can't sell it. There won't be any bids for any higher number. So the secondary market is doing one thing, and the auctions are doing one thing, and they're all coming out based on the same rates. We are demanding a higher 2-year rate than 10-year rate.
So people are happy with this 2-year rate that they're getting. At least
they're happier.
They're content enough where they say, okay, I will put my money into this particular Treasury bond for 2 years. Or Treasury bill, whatever. It's
just call it a Treasury.
We'll call it a Treasury. Yeah, I forget where the cutoff is. They're willing to do that over a short period of time. We said at the beginning of this episode that there's talk more about higher interest rates coming. I mean, we don't know, but there's more talk that they're going to raise interest rates.
Chairman Powell said he's going to raise rates X%.
Which would, I would assume, mean that the shorter term, like the 2-year, would also follow going higher. There is, and what I'm saying is,
but it doesn't always equal 1 for 1.
And, no, I understand that,
but
but
it may not happen for we think he's going to do it next month, and then the following month, and maybe that's already priced into it, so that it's not going to be, that's kind of already there, so we know that it's potentially happening. So that's why we're demanding the price now. So maybe that's why interest rates went up mid-span between when he raised them last time and when he's raising them next time.
Yeah, because if I were sitting there and saying, I'm happy with 4.4% on a 2-year, but if I'm looking forward and guessing 6-8 months from now, if interest rates are going to be higher, maybe I could get something closer to 5% on a 2-year. I don't know.
Right, but you've also just given up 2% while you're waiting if it's 6 months down the line.
Mm-hmm.
And so you need to have it at least enough higher to recoup what you didn't get for the first time, so that and most people just aren't willing to wait like that either. So the question is also, how am I going to manage my bond portfolio?
Well,
do I want to manage it myself and do individuals, or do I want to just buy a mutual fund and let somebody else manage it for me?
Well, we asked this question a couple of years ago. I had to go back into the archives, but I think it was 2020. And the question was, why would you own bonds in a low interest rate environment? Why would you want to tie up your money for 2 years, 3 years, 5 years, whatever it is, where they're paying virtually nothing
Back
then. Now the question is, why would you want to buy bonds in a rising interest rate environment when there is, at least in my mind, a good likelihood that bond, the value of that bond, is going to go down when there are further interest rate increases?
Well, that's why you're seeing people buy 6-month, 1 year, and 2 year treasuries.
Hedging their bets?
Buy bonds, with even corporates, with maturities that are in the 6 to 18 to 24 month period of time. And that's where they're buying them, because they're figuring I can buy them for that point. And if they go up, I'll reinvest in 6 months, 18 months, 12 months, 24 months if I need it. And other people, there's two reasons to be buying the bonds. One is that you're going to buy and hold it as a diversifier in your overall portfolio, and you're not looking to spend the money. You're just looking at it as a diversifier. Mm-hmm. And the other is, I'm going to ladder these bonds out because I need, let's say I needed $20,000 a year from my portfolio. I might buy a 6 month, $10,000 bond, and then a $10,000 bond every 6 months, 12 months, 18 months, 24 months. Now the question is, how far do I go out? In our typical first bucket, we're using 6 to 7 years worth of safe, reliable cash flow. So do I ladder it out every 6 months for the next 7 years? I'm not really being rewarded by buying 5 and 6 year money anymore, because I'm getting less on those than I am in 2 year money. Mm-hmm. So do I just do, if I need that $20,000 a year, do I do a $10,000 every 6 months up until the 24 and put the rest of it in the 24 and take my chances that I'll be able to reinvest at that point higher than what I'm at to now? I'm also taking the chance that maybe they get some of this inflation under control in the next 2 years, and the inflation comes back down and my reinvestment's only 3% or 2.5%.
Yeah, and it's hard to tell exactly what's going to happen with inflation. I mean, this is a worldwide problem.
But depending upon why you're investing, whether I'm investing it for the cash flow like I did in that second example, or I'm investing it for a diversifier, which was the first example, they're different strategies. They're different ways to look at, why am I buying the bonds in the first place? And so how do I go about doing it? And so what I've seen is that most people are staying shorter for the most part, except for the people that say, you know what? I'm going to ladder it out to 5-6 years, and I'm going to get my 3.9 to 4%, and I'm happy with that. And I don't care what happens. I know that I've got a bond maturing every time where I need to spend 10 grand. And they just set themselves up, and that's fine. Other people want to try to get a little more juice out of the orange.
We've talked about how historically bonds are the cushion against stocks.
Historically, normally.
You have the typical 60-40 mix of stocks and bonds. You have the stocks there to capture any potential growth, and you hope that it grows over the course of a period of time. But you've also got bonds there so that if the stocks happen to go down, your bonds will
they don't go down as much. They hopefully stay stable, but they're also creating cash flow that is being used to buy into the stocks while the stocks are down. So it buoys, you get a little bit of an internal dollar cost averaging effect with that cash flow. For years, we didn't have that, with interest rates paying 0. nothing percent.
Yes.
Now we're back into where those bonds are actually paying something, and we can get a little bit of that cash flow to help us. But it doesn't help when, my bond was $100,000 of the overall portfolio, and now it's $90,000. So I wasn't able, but the cash flow was still the same if I'm buying individual bonds. Now, the problem is when we start buying mutual funds, because mutual funds are managed to a certain maturity.
Are you talking about bond mutual funds?
Bond mutual funds.
Yeah, let's make sure people understand what this is.
They're managed to a specific maturity.
These are bond funds.
Bond funds are managed long-term, intermediate-term, short-term, ultra-short-term. And that is the maturity dates on the bonds that fund manager is going to be utilizing inside the portfolio. A long bond manager is going to be buying long maturity bonds. And so he may buy a couple hundred of them. And then when they mature, as he holds them, he's receiving the interest and using that interest to buy more bonds. But as the bonds get, he may have bought, a bunch of 20-year bonds. But as he's been holding them for 3 or 4 or 5 years, now we're getting shorter on the maturity, shorter. At some point, he has to sell those bonds because they're no longer considered long bonds. and he's a long bond manager. He's only going to be owning long bonds.
He or she.
They.
That person.
They,
yes.
them.
Right.
And so it's a matter of.
So they would
sell.
Start to have to dump.
And if
them,
they're doing that now, they're selling those bonds at a loss.
Sure.
Now,
because the interest rates are higher now.
Right. And when interest rates go up, existing bond values go down. The amount of movement, negative movement with interest rates depends on how far the interest rates go up, but also how long between now and the maturity date of that particular bond. The longer the maturity date, the more volatile the bond is. And so a 1% increase may drop a bond, 8, 10, 12%, depending upon how long it's valid, because that's the discount that you have to sell it at. So, they're buying new bonds with the proceeds, but they have a lot less than they had before in proceeds or value to buy those new bonds paying higher interest rates. And so bond funds are tough to manage in some respects when we're going through that. And so what we've seen are people sticking more to the super ultra short term, but there's not a whole lot of juice in those to do a lot with. And so it's hard to make it work.
Yeah, bond funds there's no maturity necessary. I mean, there isn't a maturity date.
There's maturity on the individual bonds, but they don't hold them to maturity.
Right. There are bonds that are dropping off, and then they're replacing those with new bonds.
When you say dropping off, it's not dropping off because they're maturing.
No, they're selling them. They have to because they've
gone from long-term to intermediate, or from intermediate to short, or whatever the case may be.
Well, exactly. And so what you have is
and for the past 20 years, that's worked in their advantage, because interest rates were coming down and the bonds were worth more.
Yes.
Because when interest rates go down, existing bond values go up.
Well, now, of course, bonds for the last 10 years have pretty much been the same.
Stagnant, but
staying the same. Now, if you have something like an inverted yield curve,
it's going to be interesting.
The shorter term bonds. See, I would think that in a normal yield curve where you have
typically rewarded for longer maturity.
Right. I would think that I guess a kind of an upward sloping yield curve arrangement. Exactly. I would think that bond funds would actually be fairly good to have. I mean, at least buying these things as
well in the strategic the portfolios that I've seen managed in the past years up until 2022, there was always a smattering, whatever the word, of shorter term, intermediate term, longer term, but they also would look at the difference between corporates and treasuries and how much we're getting there. Look at the difference between the premium we're getting for high yield versus regular investment grade bonds and see whether or not the risk is worthwhile. So they were doing all these things, but with the underlying idea that longer term bonds were paying more, they had more volatility, but we didn't see a lot of movement, so that we were being rewarded for that longer term bond. And we had the shorter term bonds for some liquidity that we could turn over and buy if interest rates changed a little bit.
Yeah.
Unfortunately, in 2022, they changed
a lot.
More than a little bit.
Yeah, upward.
And the short term went a much higher than the long terms haven't changed too dramatically.
So what has happened? What has happened to the bonds that people bought at the end of 2021, say, or sometime when the interest rates were a lot lower?
The bond funds, they've gone down in value.
Let's talk about bond funds, but the individual bonds as well.
There's a little bit difference in the way you look at that. I bought an individual bond.
Was it a bad buy for me to buy a bond in a year ago?
Why did you buy it? If I bought an individual bond in December of 2021, it was a 1-year bond that I need because I need the cash flow a year from now. I want to spend the principal from it. I was accepting of the return. I knew the return. The fact that my value has gone down is not an issue to me right now, because I know when it matures, assuming I bought a high quality bond or a treasury, I know when it matures, my principal is guaranteed right there by the issuing company.
So I'm not going to worry about selling it. I don't care about that.
I'm not looking to sell it. And the amount of difference I can get over the next 3, 4, 5 months isn't really worth it to sell it and try to buy another one of short term. So if I'm buying a bond today and I'm holding it to maturity, there could be some fluctuation. But if I'm on 6, 12, 18 month, 20, even 24 month time horizon, I'm not that worried about that, because I know that the individual bond that I bought was an acceptable return to me when I bought it, and it's maturing, and I'm going to use it when it matures.
I should say we're talking about treasuries here. Because I want to leave the risk of,
the same thing goes with corporates, but now you layer in a little, what's the investment grade? Is it a high quality bond? Is it a junk bond?
I want to make that
where
distinction.
Are we at on the bond?
I want to make that distinction. But when you buy treasuries, U.S. treasuries, you don't have to you don't have to consider that.
You don't have to consider risk, because basically, if the treasury doesn't pay, none of this matters.
So, right. So what you're saying, Professor Plum, if I'm hearing you correctly, is that the reason you bought the bond was because you were happy with that interest rate. You were happy if it provided you cash flow. You were happy with that kind of cash flow. And
I didn't buy it for 30 years. I bought a 1, 2, 3 year individual bond that was maturing in a relatively short period of time.
All right. Would it have been a bad mistake to buy a 10-year last year? Even if I said, I mean,
when did I need the money?
Here I go.
When do I need the principal of that bond?
Well,
if I needed to spend it 3 or 4 years later, yeah, that was a bad idea.
Well, that's it. We've been saying for a long time
and what did I just do?
Rates were going to go up.
What did I just do that was improper in a planning perspective? I bought a 10-year asset to satisfy a 3-year need. Was I matching my assets and my liabilities? No, I bought the wrong asset to support that need. I have a 3-year need for money. In the example you were talking about, I needed $50,000 3 years from now to support my spending for that year. And I put it into a 10-year bond because it got a little bit better interest 2 years ago.
Well, we had a normal yield curve. Yeah.
But now, when that bond matures, when I have to sell that bond in 3 years to be able to satisfy my living expenses, I have to sell it in the open market because it's not going to mature for another 7 years after that or 5 years after that. And I have to be then worried about where the interest rates are. So at this point, if I did that, I'm hoping interest rates come down so that my bond rate goes back up. Otherwise, I'm going to lose money on that bond.
Well, very good point. That's excellent. Now, for people who are considering bonds, they know they want to own some bonds, but they're afraid of interest rates going up. Are you saying that that's not the thing to look at?
No, I'm saying look at what you're trying to accomplish. If it's money, and what I've seen is that for like a bucket number one, where let's say we needed that $20,000 a year for the next 7 years. Easy math says we're going to have $140,000 in bucket number one. It's not exactly right, but just easy math. So we're going to have a $20,000 bond coming due every year or a $10,000 bond coming due every 6 months. The real question is, where should I be investing that money? What can I invest it in? And how conservative and how much guarantee do I want on that principal? Assuming I want very high quality, very high guarantees, I can ladder out $10,000 treasuries every 6 months. And so I could have 14 of them. They come due every 6 months. Now I have $10,000 to spend over the following 6 months. But do I want to ladder it all the way out to 7? Some people will ladder it all the way out to 7 years and say, hey, I don't care what happens to the interest rates. I have my income set, guaranteed. It's done. I'm not even going to look at it. I'm done. I know I've got it covered. Other people will be like, well, if interest rates go up, I'd like to reinvest. So maybe they only, like I talked about earlier, ladder out 2-3 years, and then the majority of it's available again. And they're basically running 2 ladders. They're going to go 1 year, 1, 2, 3, and then it all comes due. Now it's cash again. Yeah. And I do 3 years, 4, 5, 6, 7. There's a little bit of risk in that because what if, and this is a big what if Congress actually understands something and gets control of this inflation and brings interest rates back down? I wouldn't be even earning what I'm earning right now.
Well, inflation's out of their control. You cannot control that. Yeah. That's like I said, it's worldwide, it's supply and demand. Yeah. But the reaction to it, and which points more to the Fed than Congress.
So what if this economy actually comes under control again and inflation comes back down to a more benign 2 to 3%, or more normalized 4%?
Yeah.
From the 8.7 that Social Security got a couple of weeks ago.
Right.
From the
exactly.
From the all those numbers that were thrown around, but so if you ladder it out for all 7, you know exactly what you're getting, and if you're okay with that, and right now that's going to be 3 to 4%, high 3s to 4%. That's not the worst thing in the world. Well, the other one way you're taking a risk to hopefully get maybe 4 to 5.
I talked about a 60-40, common 60-40 mix of stocks and bonds. Maybe 60%. Somebody says, well, I need to have a 60% of my portfolio in stocks and 40% in bonds. And they say, well, why are you having the bonds? Well, because you're supposed to. Right. I need it, as I said, as a hedge against.
That's a different game than what I was just talking about.
I understand that. And the game that you're talking, it's not a game, but the strategy you're talking about makes a lot more sense than somebody who says, I'm just putting the bonds in my portfolio to hedge against stocks. Because what happened, as we said, what happened in 2022 was that strategy blew up in people's faces.
And so what a lot of the balanced portfolio managers are looking to do now is use, if they can get a short-term bond fund or short-term utilize short-term securities, bond securities inside their portfolio, they'll use those instead of the long-term bond securities, and they're getting the same rate of return with less risk.
Well, it would seem to me then that the balanced portfolio people were doing it wrong to begin with.
Well, what are they managing the balanced portfolio for? Are they managing it to create a cash flow, which I think is the inappropriate way, but a very common way in retirement planning to do it? Or are they just managing it to balance out risk? And so
maybe both.
Well, they shouldn't be doing both because it's the wrong way to create a retirement income. That's just wrong.
But
so let's throw that out the window.
Forget managers. I think there are people who are individual investors who are doing it themselves that are doing it that very way.
Yeah, but the individual investors rarely are going to be buying a balanced portfolio of individual securities. They're buying a balanced mutual fund.
So how are you, as somebody who's putting bucket strategies together? You kind of mentioned this earlier, but I want to emphasize how are like Lucia Capital Group advisor, okay?
Right.
How are they using bonds now with the higher interest rates? What is it you guys are doing?
What I'm seeing now that I wasn't seeing 2 and 3 years ago are actual individual bonds being utilized in bucket number one and laddering out treasuries, because the differential between treasuries and corporates is not very great, and the risk is obviously different.
Right.
So we're seeing a lot more individual bonds laddered out. Now, the big question is, are we laddering for the full 7 years of bucket number one? Or are we only laddering for a couple years? And a lot of people are laddering for the 2-3 year time horizon and looking to reinvest, so instead of that 140 be invested 20,000 a year for 7 years, they may have the 140 with, 40,000 coming due in the next 6 months and then 50-50. And then reinvesting it at that time, expecting rates to be higher over the next 6-12 months. And so they're still trying to manage that portfolio. They know that they're going to have money available on a guaranteed basis from those treasuries to cover the income need. And they're going to have money available to reinvest for the remainder, 4, 5, 6 years of bucket number one. And they're looking at interest rates and saying, we're going to be able to most likely, who knows for sure, reinvest at a little bit higher rate than we're earning right now.
Do you consider, I don't think inflation is going to
It's not going to miraculously go away.
It's not going to go away tomorrow, but I don't think it's going to be 8% 3 years from now. But do you have an eye out for that where you say, well, maybe somebody's spending needs are going to be higher 2 or 3 years from now? Do you take that into consideration when you're putting bonds into somebody's bucket number one portfolio?
Well, that you take into consideration before you calculate the buckets. We take into consideration what are our spending needs going to be.
So you do?
Yeah. If I'm spending 20 now, do we want to consider? One of the things I've heard a lot about is we expect inflation to be, 8% for the next couple of years, but then come back down a little bit over the 7 year period of time. So we don't expect it to be 8% for the next 7 years, but we're not expecting the 2% every year that we had for the last 10, 15 years.
Right.
So we are building more inflation into the portfolios, or I shouldn't say into the portfolio. We're building inflation more into the projected need, which then dictates how much money goes into the individual buckets, because now we know how much money we need to satisfy the corresponding liability. You got to match that asset to that liability.
It's funny how it all comes back to that. It all comes back. Short-term needs should be have matched up with short-term assets. Longer-term needs should be matched up with longer-term assets. You said in a balanced portfolio, let's say 60-40, that you don't particularly like the idea of using the bonds. Did you say this, that you don't particularly like the idea of using bonds for cash flow?
I don't like using a balanced portfolio.
And why is that?
Because they're volatile. I mean, if you look just this year, the difference between where a typical balance, average, even a good balanced fund was in December. If I'm taking money out of it, it's not earning enough. Obviously, it's not earning anything right now. They're down 15, 20, 25%, depending upon where they are. So if I had that 140,000 in my balanced portfolio that I wanted to take 20,000 out of, I'm never going to make it 7 years now because I'm down 25%. I just blew through a couple years in 1 year because I took money out. That will never recover. So no, I don't like using it. Even if I'm only doing, the typical 4% distribution rule, where I've got, $1 million and I'm taking 40,000 a year out. So I started with $1 million and I've been taking, 33 a month out of it, and it lost 15%. So now I'm down to 800,000 in my portfolio, but I still want, and what if this isn't the bottom? What if it keeps going? And this is where the anxiety and the personal emotion that dictates most people's portfolio comes into play. It's like, well, I can't stay in this, so I have to sell it when it's down 20%. And now I'm going to go to cash, and I'm never going to earn. Maybe I can earn just the 4% by putting it in treasuries for a few years, but I need more than 4 now. I need 5, so I'm still going backwards.
Well, now, isn't the idea of a balanced portfolio, though, was when stocks are down, oh, let's not take money out of stocks, let's start taking it out of our bond portfolio?
Well, no, the idea of a balanced portfolio was we just sell it and then rebalance and keep it in balance.
Sure, I understand, but isn't the manager of a balanced portfolio supposed to be looking at this and saying, wait a minute, stocks are coming down. This probably isn't a good idea. Let's forget stocks and let's just take cash flow from the bond portfolio.
But the cash flow from the bond portfolio was nowhere near enough to satisfy a 4% distribution.
Exactly.
You got 40% of your bonds or 40% of your $1 million, even if they were able to redeploy it really quickly and earn 4% on that 40%, that's $16,000. Where's the other $24,000 going to come from?
It's not going to come from anywhere.
So that just doesn't work. So
yeah,
balanced portfolios are designed for a midterm time horizon, but to be able to be reinvested and allowed to go through the ups and downs. They're designed to have a lower risk return relationship than a pure stock portfolio. So they're designed for a different game. They're designed for that midterm game, not the long-term game. You don't want to be in a balanced portfolio if you've got 30 years before you need the money.
No, that would be ridiculous because you're watering down your rate of return.
You also don't want to be in a pure growth portfolio if you need the money 6-7 years from now.
Yeah.
So but you don't want to use the balanced portfolio for the cash flow that you need tomorrow. They're the wrong asset for the wrong time period. Matching your assets and your liabilities. Balanced portfolios are not, in my opinion, designed for cash flow. They're designed for a midterm moderate growth area where you can get better return typically, and even over a 7-year period of time, even with the volatility that we had, even with the volatility we had back in 2007-8, where the average balanced portfolio dropped 25%. When we got out to the 7-8 year 9-year mark, we got out to 2013-14, that same portfolio that was down 25%, allowed to reinvest and do everything, had a reasonable rate of return for that 7-year period of time.
Sure.
It had 4, 5, 6%, 7% rate of return.
Well, maybe even better if you include, the next 5 years.
Well, but I'm saying the time horizon was 6-7 years. It wasn't 2 years. And so if you bought it in 2007 for money that you were going to need to spend in 2009, you had a bad day. But if you bought it in 2007 for money that you needed to then replenish your bucket number 1 with in 2014 or 15, you did okay.
I think you were still taking a risk.
Historically, it's not much of a risk, but it's and 6, so for you, years? Maybe a balanced portfolio would not have been appropriate for a bucket number 2. Maybe you wanted something more secure. And there are different investments. They're not the only investment for bucket number 2, but that's where they fit the best.
So you don't see, I guess the question at the beginning was, are bonds risky as interest rates are rising? Why would you own them? You've made a case for that.
It depends on why you're buying them and how you're doing it. If you buy them for the wrong reason, they're risky. I mean, in the past, you bought a 10-year bond for a 5-year need because interest rates were coming down and you made more money.
Yeah.
That doesn't happen now, or may not happen now. So you could lose money in that. So you got to be careful of what the economy is providing and the investment they're using. You got to understand what the risks are and the potential returns. And this return could potentially be negative.
And as you said, why are you buying? What is your reason for buying this in the first place?
What is the purpose for this money? I was going through a bucket strategy the other day, and we were looking at, and it was like, the purpose of this block of money is to provide cash flow for the next 6-7 years. We have an identified purpose, which gives us the parameters of what type of an investment needs to be there. This money over here has been identified as not being needed. We've overfunded bucket 1 and 2, and they've got a good emergency fund and other things. We know that they don't need to touch this money for 15 years. Why would I put a bond in that? I mean, so that's a pure stock portfolio. And so we have identified the need, and then we've associated the correct assets with that need.
For the 5th time, it's matching your assets to your liability. I love talking about this because you've been so consistent with this stuff over the years.
But I'm going to say things have changed. Well, because a couple of years ago we weren't using individual bonds; we were using something else. Now the economy has changed; we're using individual. Back in the 90s, we used different assets than we do now for the different buckets to certain degrees. But
Yes.
We used to use, laddered CDs because we could get 7% on them at one point.
Boy, that goes a way back. But the matching the assets to the liabilities has never changed.
Consistent.
That has never changed. That is entirely consistent. And that's why we talk buckets, and that's why we do buckets. And so, there are uses for bonds, and especially inside a buckets portfolio. We're out of time. I kept you a little bit over time, but I wanted to at least talk about this because as interest rates and inflation and all this is on people's minds, we have this inverted yield curve as of now, where we sit. It could change by the time you're listening to this, but who knows?
I don't see how, but
I don't see how, but depends on when you listen to this. These are the kinds of things that your advisor will think about. We talk bucket strategies. If you want to know more about this, give the folks at Lucia Capital Group a call, 800-644-1150, 800-644-1150. You can talk to any of them. You can talk to the advisors who all work with Professor Plum, and maybe even get to talk to Professor Plum yourself. Also, check them out at luciacapitalgroup.com. You can find a lot of this information there. Did I say Lucia Capital? LuciaCap.com.
Yeah, LuciaCap.com.
Right, LuciaCap.com. And you can find information that we're talking about here. Professor Plum, thank you so much.
You're welcome.
I can't tease next week's show because I don't have it all together yet, but it'll be a surprise. We'll see. I hope it's a good one. We'll find out. For Professor Rick Plum, Certified Financial Planner, CFP Professional, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum and Jonathan Savona are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.